Good morning, good afternoon, good evening, wherever you are. I'm your host, FD for SearchFab.tv, and in this video, I want you to imagine that you have boarded a rocket already halfway into orbit, cheering as crypto prices soar, but forgotten to strap in. That's what rolling into a bull market too late feels like for those who are coming in late. It's exhilaratingly dangerous and often ending with a stomach-churning thud. Here's a deep dive into why being late to the party in crypto is so perilous, how to spot the red flags, and how to approach the cycle like a pro. But before we jump into that, guys, this is not financial advice. I'm not a financial advisor. You want financial advice? Please find your own financial advisor who's actually qualified to give you financial advice. The information contained in this video is just for educational as well as entertainment purposes. That said, let's come back to our rocket ship, crypto rocket ship in a bull market. That is why jumping late into crypto during a bull market can hurt your finances, possibly your feelings and your psychology. First, exhausted momentum. After weeks and months of relentless gains, prices begin to flatten. At this point, even good news fails to trigger fresh buying power. That's not the case at the moment, but the bull market has been raging for the past, I could go as far as saying almost 2 years now. Been a bull market. But then the bull market starts when prices bottom and they consolidate. So a bull market starts right from the bottom of the collapse. And if that is the case, you can go back to say November of 2022. That's when prices bottomed and that's when the bull market started. So you had the whole of 2023, the rest of 2024. Now you've got the third year in a bull market if you want to go as far as that. Next, you got parabolic moves and form of frenzy. When charts go vertical and you start wondering, should I be Bitcoin at 120? When that starts trending, it's often a sign the crowd is too large and too late. Next, you got retail overexposure. A sage and new inexperienced holders like 36% of BTC holdings under 1 month hold mirrors past cycle peaks. And finally, you also have smart money exit signals, where when institutions and whales quietly exit, liquidity dries up, DEX liquidity incentives spike, yet volume stagnates. These are silent but telling signs. So in short, most of the upside has already happened. Joining now often means buying a market euphoria just before the de-euphoriation starts or begins. So what are some of the telltale signs of a topping market that also indicates that you may be late? Let's start with social FOMO rising, where friends asking and flexing posts signaling peak retail interest, which is often a contrarian red flag. Next, you got news stops moving markets. So good news, whatever announcement is made, it stops moving the market. That could be scary because we've had some bullish news from the US about stable coins and all the regulations. The market is just lukewarm, it's not moving, but then it's not moving in either direction, whether we get bad news or good news. So that is something to watch out for. Got stable coin supply going up, but activity is going down. This is cash packed in stable coins with no matching activity. That always equals sidelined capital. And finally, you also have bridge withdrawals and fragmenting liquidity. Here, funds flow to safety, no real usage. Protocols beg for volume that never comes. So when you start seeing your favorite protocol giving you all these nice APRs and all sorts of incentives, but TVL or volume is not increasing, then you know there's a problem. That is something to watch out for. So yes, those are data-backed harbingers that the top is near. Danger facing late entrants and newcomers, that's the next area I want to look at. Well, some of it you don't even need anyone telling you that because you must be aware that you can lose money. But buying near the top means high risk of swift pullbacks or full-on correction. For example, BTC dropping 20 to 30% and altcoins losing up to 60%. Cognitive bias, there are some traps related to that. Greed, FOMO, and confirmation bias override rational strategy. Selling too late or riding a pump yourself rich dream. That happens. Regulatory or macro shocks, even a crypto-friendly policy push like the US regulations can trigger a correction after overreaching enthusiasm. Unrealistic leverage, margin or derivatives amplify everything. Gains and losses and late cycles amplify volatility when sentiment collapses. So you as a late entrant or a retail investor, how do you protect yourself? Late cycle defense tactics. That's what we're jumping into next. The first thing you need to do is to scale in gradually. With the dollar cost averaging, not all at once at high level. That's dollar cost down. But then you might be dollar costing into a bear market. That's quite possible. So also need to have other feelers, not just DCAing. Be ready to take profits before euphoria peaks. Set exit zones, trailing stops, risk reward thresholds. Diversify across assets and baskets. Don't chase pump meme coins amid reckless fraud behavior. That's your mirror when he keeps on talking about his SPX 6000 or 9000 or whatever it's called, 69,000, whatever it's called. Sometimes that can end up being risk behavior. Don't follow that. Watch on chain and liquidity matrix, stablecoin flow, DEX volume, bridge movements, and fund rate divergence. Also keep asset exposure reasonable. Only risk what you can afford to lose and avoid excessive leverage. How do you enter a cycle the right way? Phase away strategy. That's something, if you are that astute and smart, a smart investor, investor, yeah, you probably don't need this, but for most of us, we need this phase-aware strategy. Accumulation phase first. Be quiet, be cautious. Smart money moves first. Markets are calm, sentiment low, price is depressed. Best opportunity for long-term exposure. Next, markup phase. Upward momentum picks up. Add selectively. Momentum strategies can work, but avoid overcommitment near peak prices because you don't know whether that's the top or not. Next, you got distribution phase. Here, it's peak zone. Time to realize gains. De-risk your portfolio. When the crowd is shouting, you should be listening and maybe exiting. So when there's euphoria, you may want to be exiting if you entered early. Next is the markdown phase. Market collapses. Shift to stable coins and defensive assets, or patience long-term holders hold, but avoid panic. Begin planning for next cycle. That is always important. You need to plan for the following cycle. Most of my picks during this cycle are based on what happened in 2021. So some of them, they were actually good purchases. If you want to know more about that, you need to check some of the videos we posted previously where we talked about our latest buys. They were based on what happened the previous cycle. So what are my final thoughts on this and who actually wins? If crypto cycles were a dance, early buzzers waltz in, riding the ball elegantly. Late buyers tumble through, dizzy, and often with bruised wallets. Winners, those who enter early, scale in smartly, and take profits when the room gets loud, and stay disciplined when others melt down. Latecomers and newcomers chasing the funnel fireworks may just find themselves holding a bankable memory, but a painful bill. Memory of the cycle, don't rush in once everyone else is already on stage. Instead, whisper your way towards the spotlight early, move with rhythm, not hype, and leave while applause is still fresh. When people are going crazy about how their wallets are inflating, showing screenshots, that's when you want to go out. You can always scale back in. If you lose, that's okay, but you still made profit. There's no bad profit. Profit is profit, right? Anyway, guys, I thought this is quite an important thing to share with most of those who are coming in early. Be careful. These markets can be ruthless. Until the next time, guys, this is FD for Switch5.tv. Bye for now.